The launch of the XRPF for U.S. investors is not merely another product listing. It is a profound stress test for the entire digital asset ecosystem, conducted at the worst possible moment. The traditional metric for market sentiment, the Crypto Fear and Greed Index, is not just indicating fear, but is clinging to levels of extreme fear, not seen in years. This psychological environment transforms the ETF debut from a celebratory milestone into a high-stakes experiment. We must ask, can a new, highly anticipated financial vehicle succeed when the very investors it seeks to attract are gripped by panic and retreating to safety? On one hand, if the XRP ETF demonstrates robust and sustained inflows despite the surrounding turmoil, it will serve as a powerful counter-narrative. It would suggest that demand for specific crypto assets is now so deeply institutionalized and conviction-driven that it can decouple from the broader market's emotional swing. Such a scenario would point to a maturing market where differentiated narratives, in this case, XRP legal clarity and payment network utility, hold real weight against macro fear. It would signal that the crypto bucket is breaking down and sophisticated capital is making granular, asset-specific decisions based on fundamentals rather than sweeping sentiment. Conversely, if the ETF sees initial hype followed by a rapid drop-off in volume and flows, it will validate the opposite thesis. That, in times of true systemic risk, the entire digital asset class is still treated as a single high-risk speculative bet. A failure to hold capital would demonstrate that for all the progress in regulation, infrastructure, and institutional adoption, crypto remains, in the eyes of the majority of capital, a risk-on proxy. When fear dominates, money exits the entire complex indiscriminately. This outcome would underscore a lingering fragility and prove that the path to becoming a mature, resilient asset class is far from complete. The timing of this launch against the extreme fear backdrop is what makes it such a critical signal. Fear this deep is not about normal volatility. It is a response to perceived existential threats, liquidity crunches, regulatory attacks, or macroeconomic collapse. The launch acts as a real-time probe into market depth. The initial 30-minute volume, a strong $26 million, is akin to a first breath. But the critical measure is the sustained respiration over the coming days and weeks. Will institutions and ETF use this moment as a calculated entry point, averaging in during fear, or will they wait on the sidelines until the all-clear signal, which in market cycles often arrives only after prices have recovered? Furthermore, this event creates a direct comparison point with previous ETF launches. Most notably Solana. The Solana ETF managed to attract inflows even as Bitcoin and Ethereum experienced outflows, showcasing that capital can rotate within the crypto universe. The question now is whether XRP can replicate or even surpass this feat. The XRP Army, a dedicated retail base, provides a foundation of support, but the ultimate test is institutional allocation. Can the narrative of a compliant, banking-aligned digital asset resonate with professional managers when their risk committees are in a state of high alert? Ultimately, this keynote is about contradiction and tension. It's the contradiction of a long-sought institutional gateway opening just as the castle gates are being reinforced against a storm. It's the tension between a specific asset's moment of validation and the market's moment of profound doubt. The performance of this ETF will provide one of the clearest, most data-driven answers we've had in years to a pivotal question. Is crypto building durable, standalone value, or is it still merely a volatile satellite to traditional finance moods? The market's extreme fear isn't just background noise. It is the crucible in which the true strength of this new asset class is being forged. The flows into this single ticker, XRPC, will tell us more about the state of crypto maturity than any analyst report or pundit prediction possibly could. We are not just watching a launch, we are watching a diagnosis. The current market panic is not a creation of the crypto world alone. It is the symptom of a profound breakdown in the traditional information and trust mechanisms that guide global capital. This crisis is two-pronged, a literal blackout of critical economic data and a symbolic exodus of the very investors whose historical success made them market oracles. Together, these forces create a fog of war where rational decision-making becomes nearly impossible, pushing markets into a state of pure reactive fear. First, we must grapple with the unprecedented data blackout. The extended government shutdown did more than furlough workers. It crippled the federal statistical system. Key reports for October, inflation data, CPI, PPI, and employment numbers were simply not collected. They are not delayed. They may never exist. This isn't a minor inconvenience. It is the equivalent of a pilot trying to land a plane at night with all instrumentation suddenly failing. The Federal Reserve's entire mandate to manage employment and stabilize prices relies on this data to calibrate its most critical tool, interest rates. The decision on whether to cut rates in December, a hope that has been buoying markets, is now being made in an informational vacuum. This forces the Fed to either guess, rely on hopelessly lagging private sector data, or remain paralyzingly passive. For institutional investors who build trillion-dollar models on this data, the effect is paralytic. When you cannot trust the foundational numbers that define economic reality, the logical move is to reduce risk exposure across the board. This systemic uncertainty doesn't stay confined to bonds and stocks. It leaks into every correlated asset, especially volatile ones like cryptocurrency, amplifying sell-offs as a flight to the simplest form of safety. Cash takes hold. Simultaneously, we are witnessing a deeply symbolic oracle exodus. This is not just a random shift in positioning. It is the deliberate retreat of the most celebrated, battle-tested investors of the last generation. The men who literally wrote the playbooks for navigating major crises. Warren Buffett's Berkshire Hathaway is sitting on a record cash pile, historically a signal he finds the market overvalued and devoid of attractive, durable opportunities. Buffett's genius is in recognizing intrinsic value. His move to cash screams that he sees neither in today's frothy, narrative-driven markets. Michael Burry, immortalized for foreseeing the 2008 collapse, is not just bearish. He is shutting down his flagship fund, Scion Asset Management. His reported 13F filing shows a staggering bet structured against the darlings of the AI revolution, like NVIDIA. His message is not one of tactical shorting, but of fundamental disbelief. His closure suggests the current market logic is so alien, so detached from historical principles of value, that his framework, which successfully diagnosed the greatest financial crisis in modern history, no longer functions. He is, in essence, declaring this game unrecognizable and unplayable by his rules. This exodus is a psychological earthquake. These men are not day traders. They are cultural icons of financial acumen. Their retreat sends a powerful subconscious signal to the entire investment community. The adults are leaving the room. It fosters a contagion of doubt that goes beyond charts and metrics. If the smartest guys in the room with proven track records of seeing around corners are cashing out or admitting confusion, what chance does the average fund manager have? The terrifying convergence of these two events, the data blackout and the oracle exodus, creates a self-reinforcing loop of fear. The lack of hard economic data makes fundamental analysis impossible, pushing investors to rely on sentiment and technicals. Seeing the legendary investors flee that very sentiment-driven environment then destroys confidence in those secondary indicators. The result is a vacuum of conviction. This is the macro backdrop against which the XRP sees launching. It is not launching into a normal dip or correction, but into a market experiencing a crisis of faith in the very systems that are supposed to guide it. Capital isn't just rotating from growth to value or from stocks to bonds. It is retreating from analysis-based investing itself because the tools for analysis are broken and its masters have walked away. For crypto, an asset class perpetually scrutinized for its fundamentals and legitimacy, This is a hurricane-strength headwind. It forces the space to prove its worth not in a rational debate over utility, but in a primal battle for survival during a generalized panic where the oldest rule in finance prevails. When in doubt, get out. The performance of crypto in this specific environment will test whether its value proposition is strong enough to survive not just its own internal winters, but the freezing over of the entire traditional financial tundra. The crypto market stands at a convergence point so profound that its direction from here will define its identity for the coming cycle. This is not merely a price junction, but a simultaneous clash of technical signals, regulatory timelines, and foundational philosophies about what crypto should be. The tension lies in the opposing forces at play: the cold, binary logic of chart patterns versus the messy, long-term evolution of real-world use and governance. Where this tension breaks will determine if crypto gets pushed back into a speculative corner or accelerates into mainstream utility. At the most immediate and visceral level is the technical crossroads, the looming death cross. On long-term Bitcoin charts, the ominous convergence of the 50-day moving average threatening to cross below the 200-day average, the classic death cross, is more than a bearish indicator. It is a potential verdict on a 4-year cyclical theory that has become gospel to many investors. This pattern has, in the past, presaged extended bear markets. Its formation now would validate the deepest fears of those who see this recent peak as the cycle top, triggering a new, prolonged period of capitulation and consolidation. It would be a signal read by algorithmic traders, institutional risk models, and retail investors alike as a command to exit or heavily hedge. The sheer psychological weight of this pattern has the power to become a self-fulfilling prophecy. However, the counter-narrative is explosive. If Bitcoin, amid this macro fear and swirling negative news, were to find a bottom before this cross completes, or better yet, to power through it to new all-time highs, it would not just be a bullish price move. It would be an ideological victory. It would shatter a core tenet of traditional technical analysis applied to crypto, proving that this market's adoption curve and fundamental drivers like ETF inflows, having cycles, and institutional integration can overrule even the most revered chart patterns. A broken death cross would signal that crypto is writing its own technical rulebook, decoupling from the predictive patterns of less dynamic asset classes. This binary technical outcome is thus a referendum on crypto's maturity. Does it still bow to traditional market mechanics, or has it graduated to dictate its own? Paradoxically, while this short-term technical drama unfolds, the philosophical crossroads plays out on a much longer, but no less critical, timeline. This is the clash between regulatory delay and adoption momentum. The delay of the Clarity Act, the crucial legislation meant to define the regulatory treatment of digital assets, until potentially 2026, is a massive institutional roadblock. It perpetuates a state of paralyzing uncertainty for traditional banks, asset managers, and publicly traded companies. It tells them the rule book is still being written, and entering the game now carries undefined legal and compliance risk. This freeze in regulatory progress actively holds back the very institutional capital that is supposed to legitimize and stabilize the market. It reinforces the Wild West narrative that crypto has struggled to shed. Yet, in stark defiance of this legislative gridlock, adoption momentum is accelerating in tangible, pragmatic ways. This isn't speculative investment, it's functional integration. Cash App's plan to roll out stablecoin support to its 58 million users is a masterstroke in onboarding. It brings the utility of blockchain-based dollars to a mainstream audience, not as an investment, but as a superior tool for payments and transfers, abstracting away all the complexity. The pilot in South Korea for instant tax refunds via the Avalanche blockchain, in partnership with giants like MasterCard, is a blueprint for government efficiency. It solves a real tedious problem, paperwork and delays, with a transparent, programmable solution. This dichotomy creates the philosophical standoff. Will crypto's growth be governed from the top down by slow-moving regulators, or will it be built from the bottom up by market demand for efficiency and new functionality? The old guard institutions wait for the Clarity Act's permission. The new builders are creating facts on the ground, demonstrating utility that becomes too widespread to ignore or reverse. Crystallized in the recent analysis around Ethereum and institutions. The report stating that for ETH to succeed, big money must embrace decentralized staking infrastructure is a profound challenge. It asks traditional finance to not just use crypto, but to adopt its core ethos, trustlessness, distribution, and censorship resistance. Many will fail this philosophical leap, preferring centralized, familiar, but antithetical custodial models. Their participation may bring short-term volume, but could undermine the very value proposition they're investing in. Thus, the Crossroads is multidimensional. On the x-axis is the technical path, bearish validation via the death cross versus a cycle-breaking bullish surge. On the y-axis is the philosophical path, stagnation via regulatory delay versus organic growth via grassroots adoption and ethical integration. Where these axes intersect in the coming months will chart the course. The most likely outcome is not a clean win on one axis, but a volatile, messy struggle, where price, driven by technicals and macro fear, and fundamental progress, driven by adoption, become temporarily disconnected. Recognizing this disconnect, the space between the flashing red charts and the quietly signing partnerships, is where the true strategic opportunity lies. The market is asking in the most forceful way possible, are you investing in a speculative chart pattern, or are you investing in the rewiring of global financial infrastructure? Your answer determines which side of this crossroads you believe will ultimately prevail. In an environment where noise is deafening and signals are conflicting, successful navigation requires a simplified framework. The current crisis is not a single event, but a cascading sequence of interdependent failures and pressures. Viewing it through the lens of 3 critical dominoes provides that framework, not as a definitive prediction, but as a diagnostic map. Each domino represents a pillar of market confidence. The order in which they fall, or whether they are stabilized, will create the narrative that drives prices and capital flows for the coming quarter. This is not about picking a single winner. It's about understanding the sequence of causality that will dictate the market's next major trend. Domino 1, the economic data and clarity domino. This is the foundational domino of traditional finance. Its stability depends on one question: can the fog be lifted? The aftermath of the government shutdown created an informational void where the most basic questions, is inflation accelerating or decelerating? Is the job market tightening or cracking? Have no official answer. This isn't just a lack of data. It's a collapse of the shared reality upon which trillions of dollars in contracts, models, and Fed policy are built. Until this data stream is restored and validated or replaced by a trusted alternative, institutional capital operates in a state of paralysis. The immediate threat is the upcoming December Fed meeting. Will the central bank cut rates into a data blackout, appearing reckless? Or will it hold, crushing the rate cut hope that has provided a floor for risk? The fall of this domino, meaning a prolonged data vacuum leading to a hawkish, uncertain Fed, triggers a flight from all ambiguous, long-duration assets. Crypto, as the ultimate long-duration, growth-dependent asset, would be first over the cliff. Stabilizing this domino requires not just the resumption of data, but credible data that doesn't smell of political manipulation, a tall order. If it stabilizes with clear, non-threatening figures, it provides the solid ground from which other assets can recover. Domino 2, the institutional sentiment and leadership domino. This domino represents the psychological scaffolding of the market. Its stability relies on the behavior and communication of the investment vanguard, the Buffets, Burrys, and flagship macro funds. Their actions are not just trades, they are powerful semiotic signals. When Warren Buffett hoards cash, he broadcasts a verdict. Nothing here is worth buying at these prices based on century-old principles of value. When Michael Burry shuts down his fund, he sends an even darker message. My entire analytical framework, which successfully decoded the last great crisis, is obsolete in this new irrational world. This creates a crisis of authority. If the proven oracles are walking away, who is left to guide? The fall of this domino, a full-blown public exodus of legendary capital allocators, would validate the deepest fears of the retail and institutional herd. It would shift the narrative from a healthy correction to a paradigm collapse. The money that follows these leaders would not just exit stocks or AI bets. It would seek the deepest, most liquid safe havens, strengthening the dollar and crushing speculative froth everywhere. This domino's fall accelerates any downward move initiated by Domino 1. It can only be stabilized by the emergence of a new, credible leadership cohort, perhaps the VC-backed tech builders or the crypto-native institutions, who can articulate a compelling new investment thesis powerful enough to drown out the old guard's retreat. Domino 3, the crypto-specific regulatory adoption domino. This is crypto's internal domino, but it is now being shaken by the external quakes from the first two. Its duality is its defining feature. On one face is regulatory delay, the Clarity Act pushed to 2026, which perpetuates institutional hesitancy. On the opposing face is live adoption, Cash App stablecoins, avalanche tax pilots, which builds undeniable utility. The fall of this domino would occur if regulatory uncertainty actively stifles or reverses adoption momentum. If, for example, regulatory attacks make platforms like Cash App retract their plans. This would trap crypto in a no man's land, deemed too risky for institutions, yet also prevented from growing its user base. However, this domino has a unique potential to stand firm or even stabilize the others. If adoption progresses so visibly and usefully that it creates its own economic gravity, demonstrating efficiency, savings, and user growth that even skeptical regulators must acknowledge, it can begin to build a defensive moat. Real utility can create price stability independent of macro fear. In this scenario, crypto begins to decouple, not by ignoring the traditional world, but by building a parallel one that is demonstrably better at specific tasks. The sequence is everything. Sequence A, the systemic crash, Domino 1, data blackout, falls, leading to Fed paralysis and macro fear. This pushes over Domino 2, sentiment, as legends flee the chaos. The resulting broad market crash then crushes Domino 3, crypto, as a liquidity crisis halts all speculative investment and adoption projects lose funding. Sequence B, the crypto-specific crisis. Domino 3 falls first due to a severe, unexpected regulatory crackdown, e.g., a stablecoin ban. This triggers a crypto liquidity crisis that, given crypto's increased correlation with tech, spills over to weaken Domino 2, sentiment for growth assets, and finally worries policymakers enough to cloud Domino 1, data clarity. Sequence C, the shakeout and rebirth. Domino 1 stabilizes first, clear, mild economic data returns. Then Domino 2 finds new footing, new leaders emerge, Burry's exit is seen as a relic. In this calmer environment, Domino 3's adoption phase shines, attracting the new capital looking for growth, leading to a powerful, fundamentals-driven rally. The XRP is the first real-time probe into this domino chain. Strong sustained flows would suggest that Domino 3 crypto's internal narrative is strong enough to resist the tremors from Dominoes 1 and 2. Weak, fleeing flows would confirm that crypto remains utterly subservient to the traditional sequence. By mapping events to these dominoes, you stop reacting to daily headlines and start diagnosing the underlying structural narrative. Your strategy is no longer bullish or bearish, but which sequence is playing out, and how do I position for the next domino in the line?